This is a brief overview of the equity method when excess basis is an issue. In this overview, I'm going to focus on a high-level discussion of how we handle the equity method when the situation of excess basis exists. You may want to go back to the overview that covers the equity method in general if you haven't done so already. And you also want to keep in mind I have an extra video called the equity method story that walks through all this with numbers. In the early activities that covered the equity method, you may not have realized it, but in those examples, the price paid for the percentage shares acquired lined up perfectly with the investee company's book value, meaning a 40% share of a $1 million book value company was acquired for $400,000. You can look back and verify this later. This is a very unrealistic, simplifying assumption that we make to introduce the equity method. Let me give you a quick idea of how unrealistic this would be. If today we were going to buy 40% of Moderna, a biotech company that has been in the news, as it is one of the companies working on a COVID vaccine, we would have to pay a price of $79.35 for every share, and we would need to buy approximately 148 million shares. That would mean a total of $11.7 billion. Now, the 2020 quarter one financial statements included $1.6 billion in book value of equity. So if we buy 40% of the company, we will be owners of approximately $0.64 billion of book value. So think about it. We're paying $11.7 billion for $0.64 billion in book value. So what are we thinking? There are $11.06 billion in excess basis, meaning money we have invested that is in excess of the book value of the shares that we bought. So it seems pretty obvious that just accounting for our book value percentage shares, following that basic equity method approach I talked about earlier, leaves a lot of our investment just hanging. Well, GAAP requires that we make our best effort to figure out what unrecorded assets make up the difference between our share of Moderna's book value and our share of its market value. If you've taken finance, you'll remember that the market price theoretically captures this present value of the future cash flows that come from owning a stock. So it can include things that don't get recorded as an asset and are things that increase existing assets that don't get recorded under GAAP. For anything that we can identify that would be a balance sheet item, we have to make adjustments. So what could the $11.06 billion difference be for Moderna? Likely a lot of it is the promise of a successful vaccine. Right now, all of Moderna's efforts are being expensed as R&D. Remember from Chapter 10? But when you read this, hopefully enough successful trials will have occurred to allow Moderna to declare success. Somewhere there will be a patent, or there may already be a patent on their books. I couldn't find one, but remember, patents can only be recognized by the company that develops them for the legal and filing fees. It's a very, very small percentage of the actual cost. So their existing patents may not even be material enough to make it to a separate line on the balance sheet. So I wouldn't be able to see them. But we can make an informed assumption that the $11 billion difference is for an unrecorded patent value. GAAP says that if we assign $11 billion to a patent, then we have to account for the $11 billion as if it was a patent, meaning we will amortize it over its estimated useful life. Remember Chapter 11? All right, so now remember that Moderna doesn't have this unrecorded patent on its books. So when we learn of the net income or loss from the year for Moderna, it won't include any amortization for the patent. Well, equity method accounting requires us to make an additional adjusting entry to our investment account that recognizes the, quote, amortization, unquote, of this patent. It would reduce the investment account and reduce investment revenue, just like it would have if Moderna actually had it on their books and recorded amortization. You have activities to look at, plus that extra resource called the equity method story that covers this idea using simple numbers. Take a look at it, and then, as always, ask questions.